Good evening, esteemed colleagues. As always, on Sunday, it's the Forex Times project, and as always, I, Dan Strelkov, invite you to the Forex Times community. Here you will find unique forecasts based on the Chicago Mercantile Exchange data, strategic target levels, as well as trading recommendations or trading signals, whichever you prefer to call them. Come join us. You will never regret it. Today, as always, we will review the probable movements of trading instruments for the upcoming trading week for the euro, gold, and the SP 500 index. Let's start with the euro. Let's immediately turn to the data from the Commodity Futures Trading Commission, which shows a decrease in buyers by 33%. This suggests that there is a high probability of a correctional decline in the euro for the upcoming trading week, which actually works in our favor. Why? For the simple reason that we have some impulsive movement followed by a zigzag in wave a zigzag in wave W, then a correction in wave X, and another zigzag in wave Y. After this, we have an impulsive movement indicating a continuation of growth. To enter the market for a buy, we need to see a correction and enter the market either from the 50% or 61.8% Fibonacci retracement levels, or with pending buy stop orders above the local maximum or slightly above the wave base. This is how we enter the market. The target levels were published in the Forex Times community as strategic target levels, but I think you also know them well. These are the clusters of option contracts plus at the moment hedge call options, which represent the maximum open interest for call option contracts, are also located very close to the target range. The market maker's loss level, the upper boundary of the range, is at the level of 1.300. So friends, the target range for our purchase is 1.0981, 1.1000. This is the target range for the upcoming trading week or maybe the next week if the correction is prolonged. We are particularly interested in the correctional decline, after which we can enter the market for a buy and take profit. The situation with gold is particularly interesting. Referring again to the Commodity Futures Trading Commission data, we see a decrease in buyers by 6% and a decrease in capitalization of the trading instrument by as much as 10%. This means that buyers have exited the market, taking their money with them, which increases the likelihood of a correctional decline in the first half of the trading week. A decrease in buyers indicates that the trend is still upward, not because of an increase in sellers suggesting a downward trend, but simply because there are fewer buyers. If we look at the structure of the market, we see that gold has a long-term upward trend. Let's take a global view to understand this better. Globally, gold shows an upward trending movement, and we just need to wait for its completion, most likely in the form of a final diagonal triangle, after which we will see a significant decline. Examining the market structure, we see a 1, 2, 3, 4, 5 wave structure indicating an impulse. If this impulse does not continue, it suggests a corrective wave. Following this, we should see a correction wave B and an impulse in the corrective wave C, forming a zigzag correctional structure. Therefore, we have an ABC pattern followed by an impulse 1 to 2, 3 with a flat correction or a flat correction in waves 4 and 5, resulting in an impulsive 5-wave pattern. We are currently seeing a correction. The question is whether the correction has ended. Hopefully, this is an impulsive wave A of the correction, followed by wave B, and then another impulsive wave C of the correction. After this, we should see a mandatory upward impulse to at least the minimum of wave A, followed by a correction, allowing us to enter the market with pending buy orders. It is essential to understand that the minimum of wave A must be absorbed. If I'm wrong and the market simply shoots up, presenting a 5-wave impulse followed by an upward correction, then we should consider selling instead of buying. To work on buying at this moment, it is crucial to remember that the previous structure is corrective, and before that we had an impulsive upward movement. Hence, an impulse correction, another impulse correction, and continuation of growth is the scenario we are looking at monthly options contracts. Regarding the monthly options contracts at the 4,000 level, an extraordinary situation has arisen. Specifically, there are almost $6 billion in call options contracts at that level. This is a substantial amount on a single level over the past 6 months. Moreover, professionals have recently added $4.1 billion to these positions. The underlying reason for this is the situation in the Middle East between Israel and Iran. I won't go into all the details, which you can find in the news, but it's clear that any escalation there could lead to significant consequences. Firstly, if the situation gets out of control, investors will likely rush to buy gold as a trading instrument to protect their financial assets. Secondly, if you are trading oil or the Canadian dollar, you need to take this into account. Any conflict in the Red Sea between Israel and Iran would likely disrupt all oil supply routes. Despite the fact that economic growth in the US is currently slowing, which in turn slows down the demand for oil, China's demand remains relatively stable. Therefore, if oil supply routes are disrupted, supply would sharply decrease while demand remains steady, causing oil prices to surge. Therefore, it's crucial to closely monitor the situation in the Middle East, as anything could happen there. And now let's move on to the S&P 500 index. Regarding the S&P 500 index, we are currently on hold. Of course, I'm not encouraging you to start smoking, but I mean that at this moment, it's best to do nothing. Why? Because after this downward impulse, there are two possible scenarios for how things might unfold. The first scenario suggests that we experienced a correction in the form of a zigzag, followed by another zigzag. It's likely that we might see yet another zigzag downward, forming a double zigzag with a connecting wave structure labeled as WXY. Only after this can we expect, following an impulse, the continuation of an upward trend. This is scenario 1. However, it's not that simple, and one scenario does not cover all possibilities. The accumulation of zigzags could easily lead to the formation of an initial diagonal triangle consisting of waves 1, 2, 3, 4, and 5. An initial diagonal triangle suggests that after a correction, the price will decline. So the forecast is this: either we see a double zigzag, an impulse, a correction, and then the price will rise, at which point we buy, or we see the formation of an initial diagonal triangle. If this is the case, we could see impulse movements within it, and after a correction, we would sell. Therefore, either buy or sell after observing the situation calmly and doing nothing for now. Once the situation resolves in one direction or the other, we will have a clearer view and can make decisions accordingly. Additionally, remember to closely monitor the situation in the Middle East, as it can impact many trading instruments. Thank you all. Have a great evening. Once again, I invite you to join the ForexTimes community. Our strategic target levels have an accuracy rate of over 80%, even up to 85%. Join the ForexTimes community. You won't regret it. This was then Strelkov. Thank you and goodbye.